Welcome to Adding Dollars. In this video, I'll be going over my weekly update on the highest volatility stocks, so stocks that are paying the highest premiums for covered calls and cash secured puts. Before jumping into this week's scan, if you're new to cash secured puts or covered calls, make sure to check out the videos in the description. Now let's go ahead and jump right into it. As always, I'm on the scan tab in the Thinkorswim platform, and I'm going to be scanning the S&P 500. So let me go ahead and switch to that and then click scan. And here you can see a column for implied volatility sorted from the highest at the top and then going down from there. This is aftermarket data, so some of this may change when the video comes out or when the market reopens again tomorrow. Paramount has been at the top of this list for a while, so I'm going to go ahead and skip that one and look at the next one. We have Warner Brothers Discovery Inc. Looks like it has earnings coming up on Friday, so potentially before this video comes out on the 23rd of February, and trading currently at $9.56 with an implied volatility of about 67%. Let's go ahead and jump over to the trade tab and see what kind of premiums that's currently paying out. I'm going to be looking at the 8 days out options, so the options expiring next Friday. As always, I have this custom column over here on the far right side called percent premium that quickly calculates the percentage profit for selling a specific strike price for cash secured puts, and also gives you an estimate here for covered calls. If you're interested in adding this custom column to your own trading platform, check out the link in the description where I have instructions on how to download it and add it to your own platform. Now let's go ahead and look at cash secured puts for this stock. Looks like you can make about 0.8% selling the $8 strike price, which would give you about $6 in premium per contract that you sell. And your risk here is if you did end up getting assigned, you would need 8, which is the strike price, times 100 because it's 100 shares per option contract. So you would need $800 if you did end up getting assigned in order to buy 100 shares of the stock. On the covered call side, you could buy 100 shares right now for $956, and then you could go ahead and sell the $10 call option strike price and collect about $35 in premium in just 8 days, or about 3.55%. Let's go ahead and jump back to the scan tab and check out another stock. I'm going to look at another one here at the top of the list. Let's look at Norwegian Cruise Line. It looks like it has earnings coming up next week, February 27th, and currently trading at $16.34 with an implied volatility of about 64%. Let's jump back to the trade tab and see what kind of premiums you could get on Norwegian Cruise Line. Again, starting with the cash secured puts, looks like you could make about 1.28% selling the 14.5 strike price put options, which means you would be able to collect about $17 in premium. And the risk, if you did end up getting assigned and had to buy 100 shares, means you would need $1,450 in order to purchase those shares. On the covered call side, it would currently cost you $1,634 to buy 100 shares, but then you could sell the $1,650 call option strike price and collect about $72 in just 8 days, or about 4.45% in 8 days. This percentage profit does seem pretty high, and that's most likely because it has earnings coming up next week and volatility is continuing to increase. Jumping back to the scan tab, let's go ahead and look at a stock that's at the very bottom of this list. So a stock that most likely has a significantly lower implied volatility at the moment. We have Procter & Gamble, or PG in this case, currently trading at $160.56 with an implied volatility of about 15%, significantly lower than the previous stocks that we looked at. So typically when volatility is lower, the amount of premium a stock pays is significantly lower relative to its price. So let's go ahead and look at an example of this as well. Again, looking at the 8 days out options and starting with cash secured puts here, it looks like even if I sell the strike price that is right next to the current price, so current price is $160.56, and even if I sell the $160 cash secured put, I would make 0.52%, which is significantly lower than the higher volatility stocks. And that would equate to about $81 in premium. And if you did end up getting assigned, you would need $16,000 to buy 100 shares. Procter & Gamble is typically a stock with a lower volatility. A lot of people like to buy this stock typically because of its lower volatility and because it doesn't have as many big moves. It's a more consistent stock, but that does equate to lower premiums when it comes to selling options against the stock. On the covered call side, it would currently cost you $16,056 to buy 100 shares, but then you could sell the 162.5 strike price call options and collect about $45 in just 8 days, or about 0.29% profit. I'm going to go ahead and jump back to the scan tab and scroll back up to the top. Feel free to pause the video and take a look at the entire list of stocks here. This is again the S&P 500 sorted by implied volatility. And if you want to help support the channel, don't forget to like and subscribe. And if you have any questions or comments, feel free to leave those down below, and I'll see you all in the next one.